Cash is king in Givaudan. When we have digested the Quest acquisition, we have defined that once we have reached a leverage ratio below 25%, that we pay out a minimum of 60% of the free cash flow in forms of dividends. Furthermore, we have also promised the market that we will increase dividends every year.
Sunrise has a rule-based dividend policy, which is actually paying out 65% of our equity free cash flow until we have reached a leverage target of 2.5 times net debt to EBITDA. Once we have reached this target, we will actually review this policy and potentially upgrade.
At the time of the IPO, we defined a dividend payout policy of 60 to 70% of net income, while maintaining a strong capital position with a Tier 1 ratio of at least 18%. Then, due to the accumulating excess capital, we later refined the policy with regards to the future distribution of excess capital. We intend to return capital above 20% Tier 1 to shareholders, either via extraordinary dividends or via share buybacks, unless there is a more efficient allocation of capital for internal or external growth.
VAT intends to distribute up to 100% of free cash flow to equity in form of dividends back to the shareholders. Of course, barring unforeseen events, as long as net debts do not exceed EBITDA more than 1 times.
Cash is the hardest measurement you can find to measure profitability of a company. Everything within Givaudan is based on free cash. Long-term incentive plans for management and, as mentioned before, also the dividend payout to the shareholder. We want to be aligned between what we promise internally and what we promise to the shareholder.
The core strength of Sunrise is actually the strong cash flow generation of the business. So we wanted to actually remunerate our shareholders based on that strong cash flow. So we wanted to give a predictable and transparent policy, and that were the key motivations for us to select the policy.
We have a highly successful business that produces strong cash flows. However, there is limited growth in the Swiss consumer finance market, so we generate excess capital every year. There's no need to continue to build up capital of 20% Tier 1, so returning to our shareholders is for us the best option.
Free cash flow is an understandable and transparent KPI for everyone. Since dividends are also paid out of free cash flow, it's only logic to link a dividend payment with the free cash flow. And at the end, free cash flow shows the much better performance than net profit or net income. With free cash flow, we can pay either repay debts or we can pay dividends. And therefore, VAT decided, as long as we don't require debts and achieved our net debt level, everything else surplus will go back to the shareholders.
Since the IPO, we have positioned Chamber as a dividend player. And we see a lot of income funds, insurance, pension funds amongst our investors. When we then announced the refined policy, the market feedback was very positive, given the increased clarity and predictability. With the new 18 to 20% Tier 1 target range, it's very simple for investors and analysts to model potential future capital returns.
Especially long-term thinking investors have welcomed this policy. Because if you're a pension fund, if you're an institution, if you're a foundation, if you're a family office, you need cash. And therefore cash is really what the people look for.
The reactions are very positive, and we feel as the market fully understands our dividend policy and appreciates the transparency.
Well, we actually did our going public with that policy, so the market actually supported that very positively, and as a result the IPO went well.
This evaluation we leave it up to the shareholders and investors. However, since the IPO on April 14, 2016, our share price has performed very well. And this is thanks to a unique combination of growth and an attractive dividend yield of around 4%.
Since the IPO, we have increased the dividend every year. and the stock has strongly outperformed the Swiss market. We have returned about 500 million to shareholders via dividends and buybacks since the IPO. The total return for investors who invested in the IPO, which was in October 2013, has been 85% until now.
We have a lot of positive feedback from all of our investors because of the great transparency and predictability.
I can't really say whether it's coincidental, but since we paid out an increased dividend, the share price has developed absolutely fantastic. Whether that's the only reason for this development, I would say no, it's definitively also the overall performance of this company.